The crypto world is asking itself one question. Is it time to sell in May and go away? Now, in the past, this would have been a good idea. Does it mean it's going to be a good idea this time? That's what I'm going to get into today. We're going to look through what are the headwinds coming for crypto, what are the tailwinds coming for crypto, and in the end, which is the bigger risk, staying in or going away? If you want to find out what the move is for the month of May, throw me a like and a subscribe down below in the top end. Now, very quickly before we hop in, happy Cinco de Mayo. I realize it may be the 6th, maybe even the 7th, but at the time of recording, it is the Cinco of the Mayo. And so happy Cinco de Mayo to everybody. So let's figure out what the hell is going on with the month of May. So we're going to break down what are the risks, what are the tailwinds for crypto, for Bitcoin, for altcoins moving through the month of May. I'm going to start off with the good news because in my opinion, there's more good news than bad news. A few things that I think are relevant here. Now, as we've seen, Bitcoin is just ripping higher. Doesn't matter. Hormuz, Iran, bombs, ships, oil, doesn't matter. Bitcoin's trending higher. And I'm going to tell you why that is. And I'm going to tell you why I think these catalysts could continue through May, but there is a risk. There is a very real risk, and that's something I'm going to take you through as well. Now, to start off, I want to show you this. This is the U.S. 10-year Treasury. Now, you might ask yourself, what the hell is this? What this is this is telling you how much return people who buy U.S. debt want. So if it's 4.3%, that's the return they want for buying, locking their money up for 10 years. And we've watched this go higher. You look over the last 3 months, this has gone higher, 4% up to 4.3. That's a significant move for bond yields. And we're watching this go higher. So investors are anticipating inflation. That's what this means. This means that, you're going to debase my purchasing power. So if you want me to tie up money with you for 10 years, you're going to have to pay me a little bit more. And I started thinking about this. Bitcoin is a monetary inflation hedge, right? We buy Bitcoin because you can't reproduce it, you can't duplicate it, you can't debase it. 21 million, that's it. Probably not even that many because a lot got lost. I decided to pull this up on TradingView. So we got Bitcoin here in orange, we got the US 10-year here in green, and are you seeing what I'm seeing? Seems to be a somewhat tight connection. Obviously some divergences here, but you can see that. I mean, Bitcoin has kind of been following the 10-year around. The 10-year dropped, Bitcoin went higher, Bitcoin fell. I mean, it basically fell to the exact same level as the 10-year, if you're looking at like a logarithmic situation here on TradingView. And so as the 10-year goes higher, Bitcoin goes higher. Now, why is this? Well, because as we're pricing in more inflation, as we're anticipating more inflation, Bitcoin goes higher because it's a monetary inflation hedge. Also, it doesn't have counterparty risk. So when you have an Iran situation or whatever else, and so when you're looking for a safe bet, a monetary inflation hedge like Bitcoin and gold can hold your value while there's volatility or inflation going on. And that certainly seems to be what's going on. California gas prices at $6 per gallon. Fuel costs jumped nearly 30 cents. I'm sure you're all painfully aware at this point. Now, what we had last year too, we had core PCE trending higher. We had core PCE at 3.2% above previous 3, and we had headline at 3.5, well above the previous 2.8. And this is only going to increase. There's definitely going to be an inflation shock coming for us. Prices are going higher. Inflation is going to go higher. Bitcoin may be the desirable asset in that case. And there's another reason why I think this is going up as well, and it's liquidity. Now, I want to show you this chart right here. And this is the global liquidity proxy over from 42 Macro, Darius Dale. Definitely check them out if you're a macro nerd such as myself. But what we saw back in March really was a rather conspicuous divergence from Bitcoin and global liquidity. You can see how tightly connected this was. And the stock market certainly followed it higher, but Bitcoin had a little bit of a divergence. Now, you could say that's because of manipulation or because of a deleveraging event. We went over this a few videos ago, but ultimately this is what's going on. And now it seems as though Bitcoin is playing catch up. Bitcoin is playing catch up to liquidity, and it's also, I think, catching a bid because of inflation pressures. And what you're seeing here, the Fed has increased its holdings of U.S. Treasuries. What does that even mean? The Federal Reserve is buying debt, absorbing debt. Why? Because nobody else wants to buy it. And so they're coming in, and if you zoom in, I mean, look, December 2025, up and to the right. Now, there's something else in the background that's been pushing liquidity higher as well and will continue to do so. This is something I actually talked about a lot last year, and I was signaling ahead of this and showing people like, hey, this is something that's going to happen, and it happened. So if you want to get insights like those and stay ahead of the game, throw me a subscribe down below. Put a lot of work into these videos, and I stay up to date with things so you don't have to worry about it. Final rule to modify the enhanced supplementary leverage ratio. What the hell does this mean? Essentially, supplementary leverage ratio is how much cash or how much liquidity do banks need to hold in relation to how much debt or how many bonds, how many treasury bonds that they hold, how much debt that they hold. So if you're a bank and you need to have, let's say, 10 cents of cash sitting for every dollar of debt that you're holding, they came in and they said, okay, don't worry about it. We're going to lower it down to maybe 5 cents or whatever it is. I don't know exactly the number, but essentially what they did is they freed up liquidity. They're telling banks, you don't need to have as much liquidity on hand if you want to hold debt. Go ahead and do whatever it is you do with liquidity. It's tier one capital. That's technically what it is. The banks have to have a certain amount of tier one capital. And now that they've lowered that. So that's an increase in liquidity. And I think that's part of what's driving this higher. And then you've also got the US Treasury injecting liquidity. And this is something, again, I was talking about for a long time, and it's Treasury QE. And everybody wants QE. The Fed's going to do QE. They're going to print money. Powell with the money printer cranking it out. And now it's going to be Kevin Warsh. This is going to be a shift. So what we're going to see a shift from the Federal Reserve printing cash and jamming cash in the system. And we're going to see it switch over to the Treasury. And it's going to be Treasury QE. And so you're seeing liquidity, bank liquidity, Fed liquidity on the rise consistently. I want to show you a clip from Michael Howell, the godfather of global liquidity. He's the one who's responsible for all of us talking about liquidity. And few people are as up to date on this as he is. He's going to break down why liquidity is expanding. Have a listen.
What happened at the end of 2025 is that excess reserves of banks plummeted, and they were basically about 400 billion below where the banks wanted. Now, by series of moves, such as the RMP, which is the reserve management purchases, and the new QE tool of the Fed, which was introduced late last year, plus changes in bank regulations, such as the gradual elimination of the ESLR. What that has enabled is banks to actually restore liquidity or restore minimum levels of liquidity quite easily.
So you got the Fed running it up, you got the private banks running it up, you got the Treasury running it up. We're looking good in terms of liquidity here. And so that combined with inflation, I think is going to be a tailwind for Bitcoin over the short term, May, June, July, I think into the summer months. This is going to be something that is beneficial for Bitcoin. One other piece here too, this is services PMIs. So this is the services component of the business cycle. And what we're seeing here, what I want to point your attention to is prices paid. 70.7, very inflationary. Now, this is another part of what has me bullish for crypto over the medium term. I don't know how consequential this will be over the short term because there is a connection between the ISM, the business cycle, and crypto, more specifically the others, more specifically altcoins. And this is something I talked about a while as well. And you can look at the connection here, right? You got the others here in orange, you got the PMI, ISM, or the business cycle here in black. And you can see that they just kind of follow each other around since the inception of this thing. Higher, lower. They track pretty closely because, again, the business cycle really is a temperature check on the average investor. So you have PMIs moving higher. You have the business cycle moving higher, right? Anything above 50 is expansion. So we're expanding. The economy is expanding. But it's, you look at some of these subcomponents to this and you see, okay, it's a little bit of a slower expansion, right? What you want to see is high 50s. High 50s, low 60s, we're ripping. That's gold. That's where we want to be. So you still see employment in contraction. You see new orders. We had a fall in new orders. And then what we also had, U.S. leading economic indicators from 0.3 down to negative 0.6%. Okay. And so what that's telling you is that there are some parts of the U.S. economy that just aren't firing up yet. You have the AI build out, the data center build out, something I've been talking about for a long time. It's going to drive PMIs higher, business cycle higher. The other parts of the economy aren't there yet. So That's where you want to see. You want to see this start to move higher. So this is cautiously bullish. This is what this is telling us, is cautiously bullish. So in terms of a business cycle component to the month of May, I really would put it at neutral. It's not going to hurt. It's not going to help particularly, because we're floating around that low 50s territory. And this is good. This is better than where we've been. Again, if you look, 2021, we're at the mid 60s. 2017, we're at the high 50s and 60s. And where have we been? And this is why I would argue we didn't have an alt season last year. Is because, look, how are you going to have an alt season when the temperature check on the retail investor is contracting? It's just not going to happen. So you've got the beginnings of a surge, but really you need to see it get up here. So this is, I think, neither a headwind nor a tailwind. Now, that's the good news. You got liquidity on the rise. You have Bitcoin, tailwinds, inflation. I think there's going to be a continuous bid for bonds from the Fed and the Treasury. It's going to push liquidity higher. So what's the bad news? Well, misplaced euphoria could be the bad news. And this is maybe more relevant to the stock market. But I think if we see a big panic, I think we could see everything sell off. So let's dive into this and figure out what's going on. Misplaced euphoria as markets are sleepwalking into a recession amid Iran war oil price shock. Now, when you're talking about the price of gas going so high, what this is going to do is it's going to destroy people's ability to buy other things. And you might already be in that position. Gas is, again, we're in California, $6, maybe even $7 now. And Powell warned about this at his last FOMC. He says when you're spending so much money on gas, you're not going to have money to spend on other things. And so this is a risk. This is something that we have to be mindful of. And so there are limits to how high oil prices can go before we start to see cracks in the global economy. I want to show you a clip from Armin Panosian. I think that's how you say it. He's from over at Oaktree. He's going to point out the risks that he's looking at, what his company's looking at. Have a listen.
So we're opening the strategic reserves globally. The IEA has already distributed about 100 million barrels of that 400 million barrel commitment. So that's what's smoothing over oil prices. It could be a lot worse if the strategic reserves were not released. So we're watching that very closely. But if this elevated price action in both crude and refined products continues for a few more months, it's going to be a huge problem for the economy.
Now, there is one more risk to markets that's coming in May, and it is the appointment of Kevin Warsh. Now, do I think Kevin Warsh is going to be bad for crypto? No, I don't. In fact, I'm actually quite bullish. These are his crypto holdings, and the fact that he's a Friends with Benefits Web3 community social token holder has me very excited. But what does tend to happen, at least the last 10 times out of the last 13, is the markets will test a new Fed chair. And so with bond yields and inflation on the rise, the markets may test him to see how is he going to react to inflation, how is he going to react to prices. This is how markets test a Fed chair. And it's something that Tom Lee, essentially the Michael Saylor of Ethereum, has been keeping an eye on. Have a listen to his risks for the short term.
Yes, I think once we're through, this is still going to be a very tricky year because we have a new Fed chair coming in the market. It's going to test that Fed chair. But once we get through that subsequent turbulence, we are probably entering, an 18 to 24-month period that might be one of the best we've ever seen in our life.
And I am inclined to agree with Tom. In the short term, we do have risk. We have oil prices going higher, inflation, new Fed chair. Markets do usually test the Fed chair. So, expect that to be a possibility. However, on the other side of that, it's looking like clear skies. And aside from the Iran war and inflation, we have a setup that's known as Goldilocks, where growth is accelerating, inflation is tamed, and policy is favorable. And again, this is something that we've been pointing to, that we're going to have strong support from the Fed, strong support from the fiscal side, the government side, a lot of money coming in from the government. You have inflation that up until recently was, relatively well behaved around the high twos. Not ideal for the Fed, but I think that's actually where inflation kind of belongs. Maybe that's a hot take. And then you also have an accelerated growth from the AI build out and profitability coming as a result of that. So these are very bullish things. And these are factors that are not going to go away anytime soon. That's why Tom is very excited about the next year or two. It's also why I'm excited about the next year or two. But what about the next month? What about May? What does all of this mean? Well, essentially, as you know, we don't give financial advice here. But if I were to make a decision here, I would maybe leave a little bit of powder on the side. But I don't think now's a time to go away. In fact, I think now's a time to start getting more excited on crypto than ever before. And in the near future, likely to reach trillions. The American Bankers Association signaling that the currently immature stablecoin market of roughly 300 billion will not resemble a future market reaching 1 to 2 trillion. They even put estimates as high as 4 trillion by 2030. if the bull case plays out. Now, this does not seem like a time to be going away because of some turbulence possibly in May. I think that the underlying increase in liquidity, the underlying expansion in the US economy, and the support coming from the Fed and the government, as well as a lot of money printing that's happening in China, and maybe that's a whole other video, but those are the two global liquidity pillars. They're pushing money into the system, regardless of whether we have turbulence in May, June, or July. I think that if you're holding Bitcoin right now, you're probably going to be happier than you would be upset 3, 4, 5 months from now, regardless of how the near term shakes out. So there are risks to both sides. I can't tell you what to do, but I can give you the information, help you make the best decision that you can make on your own, and wish you the best of luck. And all I ask for in return is that you throw me a little subscribe down below. We're trying to get to our goal of 1,000 subs. Humble beginnings here at CryptoRant, but we're hoping to make it big. Also, leave me a comment. Let me know if you learned anything. Are you planning to go away in May, or are you sticking around? In either case, thank you for being here. We'll see you in the next video.